$1.65 trillion of debt that does not appear on any balance sheet. That is what is now sitting underneath the AI boom. And last month, the central bank of central banks named an AI bust one of the top risks to the entire global financial system. Welcome to an AI Daily Deep Dive. Today we are not asking the tired question, is AI a bubble? We are opening up the machine itself, where the money actually circulates, the hidden debt nobody books, the quiet repricing that has already happened while the headlines looked away, and the exact dials that will tell you what comes next. One rule before we start. Everything here is fact and mechanism, and nothing is investment advice. Let us begin with what actually happened. The timeline first, because the sequence matters. In mid-June, the AI trade hit its high-water mark. Korea's Kospi peaked on June 22nd above 9,100, up more than 80% for the year at that point. SK Hynix, the memory maker at the heart of the AI supply chain, peaked the same day. Then the air changed. On June 23rd, the Kospi fell more than 4% in a single session. And on July 2nd came the rupture. After U.S. chip stocks slumped overnight, Samsung and SK Hynix tumbled together, erasing roughly $290 billion of value in one day. The Kospi sank below 8,000, and the Korea exchange triggered a sell-side sidecar halt within minutes of the opening bell. Here is the number that tells you how violent this summer really is. Korea's sidecar mechanism, the automatic pause triggered by extreme program selling, has fired more times in 2026 than in all of 2008, the year of the global financial crisis, which held the previous annual record of 26 halts. And the Korea Economic Daily reported in mid-July that forced selling of leveraged retail positions was deepening the strain. Investors who borrowed to ride the AI trade being sold out automatically as prices fell. That is the classic signature of a crowded trade unwinding. And yet, notice what did not happen. There was no crash. The market wobbled, rebounded, wobbled again. Which is exactly why this story is more interesting than a simple bubble popping. The other thing that changed this summer is who is allowed to say the word bubble. On June 29th, the Bank for International Settlements, the institution that coordinates the world's central banks, released its flagship annual report and put an AI capital spending bust alongside opaque circular financing deals among the top risks to the global financial system. Its warning, disappointment in AI returns could turn the capex boom into a protracted investment bust. When the BIS says it, the debate is no longer fringe. The other side is just as loud. Reuters reported that SoftBank's Masayoshi Son dismissed bubble talk entirely, arguing AI will need $5 trillion of investment per year by 2040. To judge who is right, you have to look at how the money actually moves. So let us open the machine. Circular financing sounds complicated. It is not. Here is the loop in plain language. A chipmaker takes an equity stake in an AI lab. The lab uses that money, plus billions in commitments, to buy that same maker's chips. A cloud provider borrows to build data centers, which it leases to the lab for decades. The lab's spending becomes the cloud provider's revenue, which justifies more borrowing, which buys more chips, which the chipmaker books as sales, lifting its stock, which funds the next equity stake. Around and around. The BIS describes a complex web of private arrangements linking hyperscalers, chipmakers, and AI labs, where deal terms are typically poorly disclosed, and where assets risk being pledged multiple times. $1 can appear as equity in one place, revenue in another, and collateral in a third. Now the scale, because this is what makes the BIS nervous. According to its report, the 5 largest hyperscalers are spending over $1 trillion combined on AI infrastructure across 2025 and 2026. AI now accounts for nearly half of all U.S. investment-grade bond issuance and 87% of venture capital funding. Private credit has piled in too. Direct lending funds have quadrupled their AI and IT sector lending in 5 years to roughly 15% of their portfolios. Allianz Research adds the intensity number. After rising about 60% last year, big tech capital spending is on track to climb another 50% this year, past $600 billion, roughly 23% of revenue, more than double the level before ChatGPT existed. Nothing in modern corporate history has scaled this fast. And here is the part that stays off the books. Nikkei Asia published an analysis this week putting a number on it. Hidden debts at 5 U.S. tech giants have soared to $1.65 trillion, roughly 8 times larger than about 4 years ago. Hidden means real, contractual, long-dated obligations that simply are not booked like bonds, chiefly data center leases and GPU supply contracts. Nikkei's starkest example is Meta, whose off-balance sheet obligations it puts at about $420 billion, nearly triple the company's transparent debt. Nobody is alleging impropriety. The point is subtler and more uncomfortable. This structure makes it genuinely hard for investors to see how much leverage is in the system. This is why 2026 feels different from 2024. The boom's funding quietly moved from cash into structures. Now the scoreboard, and this is where the story turns genuinely surprising. All figures are real closing prices from live market data, measured from each stock's 2026 peak through this week. The Nasdaq is only about 5% off its high. But underneath that calm surface, Oracle has fallen 49% from its June the 1st peak, nearly half the company's value, gone in 7 weeks. Palantir is down 31%. Microsoft, down 19%. Meta and Alphabet, each down about 15%. Meanwhile, Nvidia is off just 10% from its peak and still up 12% for the year, and AMD, fresh off its Anthropic deal, is up 147% year-to-date. In Korea, SK Hynix sits 33% below its June peak, yet is still up 187% for the year. Read that pattern carefully, because it is the single most important insight in this video. The market is not repricing artificial intelligence. It is repricing leverage and story. The names hit hardest are the ones most exposed to the debt structures we just described. Oracle, which Nikkei named explicitly in its hidden debt analysis, or the ones trading mostly on narrative. The names holding up are the ones that pay for their chips out of operating cash flow, with earnings you can audit. In other words, the first chapter of the repricing has already happened, selectively, without any index crash, while most headlines were still asking whether it would ever begin. Keep one number in your pocket for later. Nvidia, the most valuable company in the boom, trades at about 32 times trailing earnings. Remember that for Chapter 5. So the supply side is levered to the sky. The bubble question therefore lives entirely on the demand side. Will anyone pay enough, for long enough, to service all of that? And here the first warning light is price. A price war has broken out at the frontier. The Wall Street Journal reported in June that OpenAI is weighing steep price cuts to compete with Anthropic. Anthropic is running introductory pricing on its newest Sonnet model at $2 per million input tokens, undercutting most of the market. Google's flash line sits in the same range, and Google has reportedly cut its top consumer plan from $250 to $200, adding a cheaper $100 tier. Chinese open-weight models set the floor far lower still. Prices for frontier intelligence move in only one direction, down. The second warning light is the customer. NBC News reported this month on growing unease inside large enterprises about the size of their AI bills, and Quartz reported that a growing number of enterprise customers are trimming spending with OpenAI and Anthropic, shopping for cheaper alternatives, and demanding clearer returns on investment. Anonymous professional forums tell the same story. Teams asked to justify tools they adopted in the honeymoon phase. None of this says AI does not work. It says something more ordinary and more dangerous for the CAPEX math. AI is becoming a line item, and line items get audited, negotiated, and cut, precisely while the infrastructure to serve them is being financed on the assumption of unlimited growth. But honesty requires the counter-evidence, and it is loud. This very week, Alphabet reported one of the best quarters in cloud computing history. Google Cloud revenue up 82% year-over-year, and a backlog of signed contracts worth $514 billion, up $52 billion in a single quarter. That is contracted future demand, not hope. Moonshot AI, maker of Kimi K3, literally stopped taking new customers this month because it ran out of compute. And Anthropic just locked in 2 gigawatts of AMD chips, plus a $19 billion, 20-year data center lease. So hold both facts at once. Some buyers are cutting back, while others cannot buy capacity fast enough. A glut and a shortage are both true right now. The question is which one is true where the debt is. So is this 2000 all over again? Here is what rhymes, uncomfortably. The circular deals of today are the direct descendants of dot-com-era vendor financing. When telecom equipment makers lent customers the money to buy their gear, the BS itself draws the parallel. The off-balance sheet structures echo an even darker corner of that era. And the BS offers a longer warning from history. Canal mania in the 1830s, the British railway bubble in the 1840s, the dot-com boom. Everyone built genuinely transformative technology, and everyone still ended in a recession. One more rhyme, and it is about you. With U.S. stocks now around 64% of the global equity index and household equity exposure roughly double what it was in 2010, a bust would not stay inside the tech industry. Now what is genuinely different? And this is why the smartest framing is that this is no ordinary bubble. At the peak in March 2000, Cisco, the NVIDIA of its day, traded at well over 100 times earnings. NVIDIA today trades at about 32 times. That number from Chapter 3, because its earnings are enormous and real. The hyperscalers fund most of their capex from operating cash flow, not junk bonds, and demand is contracted years ahead. So the equity market is not the fragile part this time. The fragile part is the plumbing, the opaque, interlocking credit structures we opened up earlier. Which means if this breaks, it likely looks less like a dot-com stock crash and more like a credit event, quieter, slower, and harder to see coming. That, precisely, is the BIS's warning. So what do you actually watch from here? 5 dials. 1. Capital spending guidance this earnings season. Intel reports Thursday. The rest of big tech follows within 2 weeks. Watch whether anyone blinks on next year's budgets. 2. Credit. Spreads on AI-linked bonds, and the private credit funds the BIS flagged. That is where stress would show first. 3. Memory prices in Asia. A price move by China's CXMT rattled the whole market last week, and memory is the boom's most cyclical nerve. 4. Korea's sidecar counter. Every new halt tells you how crowded the trade still is. 5. July 27th, when Moonshot has promised to release Kimi K3's full open weights. Every leap in cheap intelligence turns the price war screw another notch. And keep this week's clearest signal as your framework. Alphabet delivered a historic cloud quarter, and the stock barely moved. That is the market telling you the regime has changed. Spectacular AI growth is now the baseline expectation, already in the price. From here, only profit and proof move the needle. 2 honest endings remain on the table. In one, demand keeps outrunning supply, the contracts get paid, and the word bubbly turns out to be the sound of a railroad being built. In the other, returns disappoint. The financing loop we opened tightens into the BIS's protracted bust. Nobody knows which, and anyone who claims certainty is selling something. But you now know exactly which dials decide it. No predictions, no advice, just the machine, opened. That is the deep dive, the sell-off, the money loop, the hidden 1.65 trillion, the quiet repricing, and the 5 dials that decide the ending. We track every one of them, every single day, on AI Daily. If this helped you see the machine more clearly, subscribe and turn on notifications, and tell us in the comments, railroad or bubble. Thanks for watching. See you in the next one.